Welcome back. In our last video, we looked at a statutory merger where On the Go was dissolved into Newtune. Now, we're going to explore a different scenario for the same transaction. In Part B, we assume that no dissolution takes place. Both companies retain their separate legal identities, with On the Go now operating as a subsidiary of Newtune. This fundamentally changes the accounting process on the acquirer's books and requires us to use a consolidation worksheet to prepare financial statements for the combined entity. Because On the Go still exists as a separate company, Newtune doesn't record all of On the Go's individual assets and liabilities on its own books. Instead, Newtune records its ownership stake in one single asset account, investment in On the Go. The value of this investment is equal to the consideration we transferred, which we calculated in Part A as $921,500. The credit side is identical to the merger scenario. We credit common stock for its par value and the rest to additional paid in capital. The entry for the $32,700 of stock issuance costs, reducing additional paid in capital and cash, is also exactly the same. The key difference is the debit. Instead of a long list of assets and goodwill, we have this one clean line, investment in On the Go. So, if the assets and liabilities aren't on Newtune's books, how do we present a single, combined set of financials to investors? We use this, a consolidation worksheet. This is a tool. It exists only in our work papers, not in the official accounting records of either company. Let's look at the columns. First, we have Newtune's accounts after the investment and stock issuance entries we just discussed. Next, we have On the Go's accounts at their original book values. This is important. We start with their book values here. The next two columns, consolidation entries, are where the magic happens. Here, we'll post entries to simulate the combination. And the final column, consolidated totals, shows the mathematical result, what the combined company looks like. There are two primary consolidation entries we need to make on the date of acquisition. They are often called Entry S and Entry A. Let's break them down. Entry S eliminates the subsidiary's stockholders' equity. The S is for stockholders' equity. We need to remove On the Go's equity accounts, so we don't double count them with the parent's equity. This entry effectively swaps the subsidiary's equity for a portion of the investment account. So, we debit On the Go's common stock for $50,000, its additional paid-in capital for $30,000, and its retained earnings for $230,500. The total credit of $310,500 goes against our investment account. Now for Entry A. We debit trademarks for $164,250 to write them up to fair value. We debit the record music catalog, the new R&D asset, and the goodwill we calculated earlier. We have a small credit to receivables because their book value was slightly higher than their fair value, and we have a debit to notes payable to adjust it to its lower fair value. The balancing plug for this entry is a credit of $611,000, which eliminates the rest of the investment account. And here is the most satisfying part of the worksheet. Look at the investment account row. We started with a balance of $921,500. Entry S credited it for $310,500, and Entry A credited it for the remaining $611,000. The result in the consolidated column is 0. This is our proof. The investment account has been fully eliminated and replaced by the underlying assets and liabilities of the subsidiary, recorded at fair value, along with goodwill. From here, we just do the math across each row to get our final consolidated totals. So what's the big takeaway? Look at the final result. The consolidated balance sheet we get from this worksheet is identical to the post-combination balance sheet we created in the statutory merger. We reached the same destination, but we took a different path.